I think it was earnings, and it sounds kind of ridiculous, but it was the accumulation of things that failed to break the market. I mean, this market is very fitting how we got here to this marginal new high, because it's all about the trend and trusting the trend is up and nothing about momentum. It's not about excitement. It's not about a spurt of energy coming into stocks. It's just about, well, it looks like all else being equal, we probably should be a little bit higher. And that's why I kind of think we are. Credit is very tame right now. High yield bonds at 6% or below right now as an absolute yield. That to me tells you nothing is about to break in a big way, but it doesn't really feel like we're gearing up for a big burst much higher directly.
Robert, even the
Well, I think you have to look at exactly the free cash flow growth, and I think that's why it's so much different. And what I love is I think last night's results were the perfect example of why this is a different market. We're getting excited because Google's free cash flow increases 80%, and now they have $65 billion on the books. Microsoft, $85 billion on the books, 400 basis point margin expansion. So I think the ones that are expanding their margins, I mean, it just has incredible operating leverage for the growth that they have. So I think that's a completely different environment.
Yeah, but what?
Here's the chart. It's what not to like. North by Northeast. Look, draw the trend line, take the trend line away. All pretty good stuff, and it seems to bounce off the trend line. That's the point of trend lines. You know, yeah, no trend line, all good. Now I want to talk about these three bounces. I'm going to take the trend line away. Now check this out. A 27% move in 33 days, right there. A 26% move in 28 days, right there. A 27% move in 25 days. That's awfully symmetrical. Well, put the line back in. Here, these kick off from earnings. These kick off from earnings. These kick off from earnings. Now, this time, we haven't come down to the line. In many ways, that's even more constructive because there wasn't even any weakness. The presumption is we're going to kick off with earnings and head to new highs. Big stock. It's a sector unto itself. It's bigger than utilities, the entire sector. We like it long.